let's break it down. Okay, so Trump takes over, inaugurated in January. S&P 500, 6,100 points. Okay, 6,200 points, and then tariffs. He's already sounding the war drum about tariffs before inauguration day, and so.
Oh yeah.
Okay, so what's the play? The play is let's try to drive down the stock market to reduce the interest rate. I think that is the main play. Can you raise some money on tariffs? I was like, yeah, you can raise some money on tariffs, but we have to understand the significance of tariffs. So I have to, how much do tariffs mean? This is actually the U.S. Census Bureau. This is basically the balance of trade between countries. Okay. And this is from the U.S. government directly. And you can see that there's a trade deficit of $1.2 trillion. Okay. $1.2 trillion is the trade deficit. Okay. So, and you look, it's very difficult to they even group North America right up top there. So they have $235 billion from Canada and Mexico combined. Okay. I think we've said on previous episodes before, to put tariffs on Canada and Mexico from the U.S., it's tricky because...
yeah, for sure, because they'll be right close, we're attached to each other. Yeah.
These are, integrated supply chains, right? So you're going to get tariffs at each step. You get an auto part manufactured in Ontario, and then it goes to Detroit, and it's stuck in a transmission, and then the transmission goes back to Ontario, gets shipped to Mexico, and then it gets assembled in a car there, and then it was like, so you're just going to get tariffs on top of tariffs on top of tariffs, right? And so it was not... I mean, he had everyone looking left on Canada, Mexico, Canada, Mexico, Canada, Mexico, and then he releases the list of 180 countries, and it's like every country except Canada and Mexico on there. And so is that the art of the deal? Probably. That probably is the art of the deal. Okay. So I do think there's some things that are planned, they're the art of the deal, and some things that they're probably surprised on too. So I think that was probably the plan all along. In terms of the tariffs, because let's say if it's just, what is the problem that they're working with? We got to go back to the problem. So always this is the problem, because people they zoom in and look at the problem. You got to zoom out and look at the problem. The problem is that they're $37 trillion in debt, and they have a $2 trillion deficit every year. A $2 trillion deficit every year. Okay, so what happens if and you have to get this deficit down to 3% of your GDP. So GDP is at 29 trillion. Let's call it 1 trillion for sake. Okay. Sure. So this is $1 trillion over. Okay. And that's just not me thinking about that. It's like, I think Ray Dalio came out and gave that number. I've been telling people optimistically a mature economy can grow by 3% a year. Ray Dalio came out, I think this week, and actually stated that exact same number. Okay, so this, instead of being 2, it needs to be 1. Okay, so you have to reduce expenditures or you have to increase revenue. Okay, so you have $5 trillion in revenue and you're spending $7 trillion. Okay, so you have a $2 trillion problem. You can actually have, you can have your debt grow in proportion to your GDP. It'll probably be okay. It's not ideal, but it's okay. You're treading water essentially. Okay, it's like your mortgage payments going up in proportion to your income. Okay,
sure.
It's not ideal, but it's okay. Okay, so a $2 trillion issue. So let's go back to this list here. Canada and Mexico are only $235 billion. So you start talking about a 10% tariff. Okay, that's only $23 billion. You have $1 trillion problem, and you slap a 10% tariff on Canada and Mexico. That's only that's only $20 billion. It's only $23 billion. Okay, so I mean, even a 25% tariff, it doesn't work on that. And so what happens? Sounds the war drum on tariffs, and hammers on Canada and Mexico. And then when the list of tariffs comes out, it's basically everybody but Canada and Mexico, right? With kind of these 10% baseline tariffs. Now, tariffs are like taxes, okay? Tariffs are like taxes, where people think that you could raise tax rates to 99% on the rich and somehow the government would just rake in all the money. But there's something called a Laffer curve, okay? So basically with, a Laffer curve on a crude basis, like if you charge 0% on tax, you will have $0 in tax revenue. But if you charge 100% on tax, you'll also have $0 in tax revenue because no one will put any capital to work. The capital will flee your system. And people will do any sort of crazy planning or even downright tax avoidance not to pay, because the worst they're going to do is go to zero anyways. So, right. And so somewhere in between 0% and 100% will be the maximum amount that you can raise. And on tax, like most people, pretty much agree it's somewhere between 35 and 45%. And so like if you're looking at like actually maximizing the revenue, it starts to after call it 40%. The revenue that the government collects actually starts to go down when you look at the data objectively. So people say just tax the rich 60%. It's like, all the historical data suggests that you might feel good about that higher rate, but they're actually going to get less money out of them because capital is going to flee, less money is going to go to work. Like, why am I going to take a risk with capital if the government's going to take 90% of it? I won't. Like the risk reward just isn't there, right?
Exactly. Especially when we have an open continents that you can do business. You can do business in China. You can do business in South America. You can do business other places. You can put your capital to work somewhere else rather than Canada.
So now, hammers down, and then it becomes a 10% tariff. Okay, so it becomes a 10% tariff. But look at what the tariffs would have been to begin with. 10%. I think 10%. Like you got a shot at getting at 10%. And first of all, like, it might sound really good that you're going to put 100% tariff on China and 10% on everyone else, but you know what China's going to do is they're just going to ship that stuff to Vietnam or Turkey and slap a different sticker on it, and then it's going to come to the U.S. Right?
Yeah, well, then you're talking about intellectual property theft, and they don't care.
Yeah, like it's just good. It's like Russian oil, right?
Yeah,
it's oil. It's product. So like you're not really going to be able to police that very well. So when you have really high tariffs in one jurisdiction and really low tariffs in another jurisdiction, it's going to become just really difficult to police that. So it's almost pointless. It just increases their shipping cost is all it does at a certain point, right? Where, maybe if you have a 15% in China and a 10% everywhere else, it's not worth shipping it around. But once those start to get too different, it's going to be, it's not going to work. So.
Well, I think what people say about tariffs is like nobody wins a tariff war. Like nobody is going to win in a trade war, especially in this interconnected world. Like everyone's been pushing for globalism and connected markets and all of these things for decades. Now all of a sudden you want to decouple all of that and reverse it in a day or in the matter of like a 4-year term. It's going to cause turmoil and disruption, and in the long run, I just don't think it's going to work.
Yeah, right? I think on an optimistic basis on tariffs, you could have got 10% on that, and so that $1.2 trillion basically would mean an additional $120 billion in revenue. Okay, so you remember you have a $2 trillion problem. Arguably, you might have a $1 trillion problem because as long as you can cut the deficit down to that, and like this is like the optimistic outcome. I'm not telling people this is, you could get $120 billion of tariff revenue because tariffs also put downward pressure on the GDP and the efficiency, and there's a whole bunch of downsides. But I'm just saying, like, I think the most optimistic outcome of tariffs is an extra $120 billion in revenue, which sounds like a lot, but when you have a $1 trillion problem, it doesn't solve the problem. It doesn't solve the problem. It helps, okay? So at most, they knew going into this that probably the best outcome, $2 trillion deficit, you need to get it down to $1 trillion. Yeah. The tariffs were $120 billion, 12% of your problem, 12% of your problem, right? And Musk was sounding the war drum. On Doge. Doge is going to save us. And you even see this Doge clock that they, but basically the Doge clock is not an annual clock. The Doge clock is how much Doge is going to save us forever over the next 100 years. Okay, so Doge is expected to save us save the Americans $305 billion. Okay, so $305 billion, and I've been telling people it's like that's a forever clock, not an annual clock, and we've turned out that is correct here. I had a clip of Elon actually saying it. Let me just find this clip here, and this is what I've been confirming all along, and they're going to confirm it now. So.
Thanks to your fantastic leadership, this amazing cabinet, and the very talented Doge team, I'm excited to announce that we anticipate savings in FY26 from reduction of waste and fraud by $150 billion.
I'm going to play it back. I'm going to play it one more time. I just want to make sure. Just listen to the date.
We anticipate savings in FY26 from reduction of waste and fraud by $150 billion.
Okay. So by 26 of 150 billion. I mean, I told everybody, Elon first said, Doge is going to be $1 trillion. I remember once upon a time when Elon said, I'm going to get my Cybertruck in the next year, and then that thing was like 5 years later, and I didn't want it by that time. So I mean, that's kind of the nature of tech businesses, overpromise, under deliver on timelines and stuff, right? So $150 billion. So again, and that's by 2026. So is that like the first 18 months, the first 2 years? Is that in 2026? Like, optimistically, let's just say that's $150 billion a year.
Sure.
$150 billion a year. Okay. So that's what I tell everybody. It was never about the tariffs and Doge. The biggest problem here, I just go back to this debt clock. You have $1 trillion in interest expense. You have $1 trillion in interest expense, and a third of it is expected to renew at 5%. So current rates expected to renew at 5%.
So a third of $1 trillion renewing at 5% interest rate. So then what does that do? Like, I think that's terrible. Could you imagine, like, you have debt and you're going to be renewing at like a much higher rate than you originally bought that debt? Like, what are the implications?
That's 1.8 trillion. That will go from 1.8 trillion. So that's an $800 billion increase in your expenditures. And Doge and the tariffs combined are 270 billion. Best case scenario, best case scenario of everything they're saying, like, because that's their new 10%. That is the best, most optimistic scenario. So I'll say it again. It's like this whole thing was interest rates. Mm-hmm. This whole thing was interest rates. Like, they're not stupid people. So the whole thing was interest rates. And so here you go. Here's the play. You start rattling the war drums on tariffs, and maybe it gets you some extra money, but at the end of the day, it's like you're trying to drive capital out of the stock market and into the bond market. Okay, you're trying to drive it because as you have more buyers for bonds, they're willing to accept the lower and lower interest rate. Mm-hmm. Okay, so you're trying to drive the capital out of here into the bond market, and they're doing a pretty good job. First off, you have an S&P 500 starting at 6,100, mm-hmm. and you drive it all the way down to 4,900. Okay. This is the yield. Okay. And this is kind of what happened here. Let's go to the 3 months. And they take over. Inauguration, we're talking about 4 3/4, that 4.75, 4.5. Okay. They get it all the way down to 4%. Okay. They get it all the way down to 4%. And just a half a point alone, one half a point is more. If you have your debt renewing at 4% instead of 4.5%, that's $180 billion. That half a point is more than Doge, and it's more than the tariffs. Like just the half a point in interest is more than either of those line items, right? Like, that is the main thing that they're doing. They drive it out, but then it stopped working, and then it stopped working, right? And it stopped working.
What are the things that stopped this from working? Like, what were the trigger points? Like, what actually happened in real time. Like, that's the funny thing about this. Everything's happening in real time. Everything's happening rapid fire. Like, what happened so that it went from going in the toilet back up to like where we are today?
Yeah, like, I mean, no one's gonna know in the immediacy exactly where it went, but here are the general causes, right? And you're dealing with big organizations, foreign countries, and so some of them, their reporting is opaque, and almost all of them reporting is delayed, right? But at some point, what happens is, theoretically, you can drive money out of the stock market into the bond market, but then at some point, what's likely to happen? What's likely to happen is you end up driving money out. You spook the bond market, and then all of a sudden, the bonds. The money in the bond market starts going into gold. It could go into real estate. It could go into foreign stocks. Okay, so it could flee the U.S. altogether. Right. Okay? Yeah. And as you drive capital out of the bond market, you have less buyers of the bonds, and they want a higher and higher interest rate. Okay, and then you also have a couple other things. Is you have portfolios that are like 60-40 splits. People just blindly put their money at financial institutions that want to have 60-40 splits. So when you drive the stock market down, they will take money out of the bond market to prop up that, to keep that allocation the right way. Okay, so they have a desired allocation, and that's going to be one reason. Then you have the degenerates in the market who it's just based on margin. So they need to sell their treasuries and their bonds because they're getting margin called on the drops. Okay. Then you have bonds held by foreign holders, and as you inflict pain on them, they need to sell their bonds to buy their currency, or they just sell their bonds. If you're China, you just sell your bonds out of spite just because you know what's happening, okay? And so you get these factors that eventually it starts driving capital out of the bond market too. That's what happened. They got it down to 4, and then it went back up to 4.5. Like, basically, and that spike back up to 4.5, that's what precipitated the we're going to put the pause on here. We're going to put the pause on. Now, some people say that's a failure of this whole thing's 4D chess. It's like, they didn't know where this is going to break. Like, nobody knew. It's like, but you got to try something. Yeah, you got to try something because you have this problem, right? And so eventually, when I look at this now, Trevor, it's like I feel so much more uneasy this week than I did last week.
Yeah.
Because last week it's like I know what they're doing. They're going to try. You have no idea where it's going to break. At some point it's going to break, but you had to give it a try. You had to give it a try. It seemed like an effort. You have a chance to do it. You have to somehow get down to that reasonable level, because what you don't want is like a massive spiral,